Hi, I'm Michael Joyce with JoycePayne Partners, and I'm pleased to share with you our thoughts and insights for the fall of 2016. The question I get on a daily basis from my friends, from reporters, from our clients is how will the presidential election impact the financial markets? And it's been a question I've been pretty successfully avoiding until recently, but inquiring minds can be very persistent, and the reality is that the presidential election might have a very short-term impact on the market, but nothing more. Markets dislike uncertainty. So to the extent that the presidential election might cause some uncertainty, there could be a little bit of a correction, but that would be short-lived. And it could really provide a good buying opportunity for many types of investments. But what's really going to drive the financial markets and investments is economic factors. And the biggest economic factor that's going to impact the markets is the level of interest rates. At this time, the yield on a 10-year Treasury note is about 1.75%. And compare that to the dividend yield on the S&P 500, which is about 2.1%. Two-thirds of the stocks in the Standard & Poor's 500 index have a dividend yield that is higher than the yield on a 10-year Treasury note. So that provides plenty of support for stocks and other risk type of assets. It's not really that difficult to find some stocks of companies that have paid dividends consistently for decades without fail that are yielding 3 or 4%. So what could go wrong with that? Well, interest rates could go up more than what is expected. The Federal Reserve is widely expected to increase interest rates by about 1/4% in December, and probably increase it, let's say 2 times during the course of 2017. As much as I hate to agree with conventional wisdom, I think that this is pretty accurate. I don't think that interest rates are going to go up that fast. We think that interest rates will go up in a measured way, unless there's some type of exogenous event that impacts the world economy, or if inflation in the United States picks up more than what is expected. The labor markets are currently pretty tight, and that is a possibility, but not necessarily a probability. So 2016 has been a really great year for investment returns so far, and it's been a great year to have a diversified portfolio. And we believe that investors with diversified portfolios will have superior risk-adjusted returns over the long term, over an economic cycle, over a market cycle. So the bonus in this year, when the returns of diversified portfolios have been very good, is that it's also reduced the volatility or the risk of portfolios. So what you really need to be thinking about between now and the end of the year is to take a look at your portfolio and look at any asset classes that may have gotten out of whack, any sectors that may have gotten out of whack, and rebalance some of those sectors. It's also a good idea to look at any kind of tax losses that can be taken to offset capital gains that may have been incurred during the course of the year. For those that are still going to be making charitable contributions between now and the end of the year, you should really look to make those charitable contributions with appreciated stock. When you use appreciated stock, you're avoiding future capital gains taxes and also still getting the charitable contribution. For those people that are over the age 70 and a half, you can make some of your charitable contributions out of IRAs. And that will help satisfy those people's required minimum distribution. It's also a good time of year to look at Roth conversions. Now, Roth conversions, when you take some money from an IRA account and convert it into a Roth IRA account. Now, when you take money from the IRA account, that's going to be taxable this year, but it's going to be moved into an account, a Roth account, that's never going to have taxes. So when you withdraw from a Roth IRA account in the future, those distributions will not be taxable. And in fact, you don't ever have to distribute from a Roth IRA during your lifetime because you can let it continue to accumulate for the rest of your life. If you have any questions about any of these tactics to look at between now and the end of the year, feel free to contact your financial strategist at JoycePayne Partners. So I've been really pleased to share with you our thoughts for the fall of 2016. If you want to know more about our current thinking, please visit our website, JoycePaynePartners.com, or follow us on Twitter at JoycePaynePTRS. Thanks and have a great day.